Well, we are all aware of the banking issues that are taking place in our country, as we've had a handful of banks need assistance, and a couple of them, at least one of them, still looking for some assistance here. So we're looking for some expertise on the matter, and because of Bill and Maria's connections through hospice, they have asked Mark Harrell from CMB Bank to come in and help us with that. He's the president and CEO, and also the president of the Board of Hospice, if I have that correct as well.
Not the president.
Not the president? That would be Margaret Cogswell, right?
No, she's the CEO.
She's the CEO.
GT Schramm is the president, and Mark is...
I believe my role is vice chair.
Vice chair of the board.
Well,
which is the best role, because you only have to step in when somebody's not there.
Bad intel
the
on
mistake is mine, folks. The mistake is mine. I prompted Rob, or primed Rob, incorrectly, so my mistake.
No worries.
I wasn't going to throw you under the bus, Bill. I was just
But you would.
I was just going to say I got some bad intel there and go like this when that happened there. Mark, good morning to you.
Well, good morning, Rob. It's a pleasure to be here.
Thank you for coming in. So if you could, tell us why for about a dozen years things seem to be going along smoothly, and then recently it's been bank after bank after bank that's run into trouble. What's going on out there?
Well, certainly there are some concerns that have been raised out there in some of the community bank space, but primarily it's in the large bank space. And I wouldn't consider it a groundswell at this point, with all the media attention given to a couple of the banks. They've been characterized as idiosyncratic. And that's kind of the first characterization that we kind of heard about those banks. And I think that's really driven by their high concentration in a couple of sectors in the industry. And so that really becomes the first fundamental challenge, in particular with SVB Bank. Rob, they grew.
Excuse me a second. SVB, Silicon Valley Bank.
Silicon Valley Bank. Yeah, thank you. Thank you for that, Bill. So if you look back, kind of go back a couple of years to the beginning of 2020, Silicon Valley Bank really had exponential growth. They grew from the beginning of 2020 to the end of 22, just in 12 quarters, from $70 billion, and yeah, that's a B, so it's hard for us to get our heads around billion. Mm-hmm. But what's important is how quickly they grew. They more than tripled their size in 3 short years. And for any industry, including banking, growth can present consequences. And so they face some consequences with their growth. So that's kind of the first fundamental challenge that SVB faced, and that was true with Signature Bank as well.
Okay, so when I think of a bank, from my generation, you think of a building. Kids today might think of it as just something that exists out there, kind of in the Ethernet.
Yeah.
We give our money to banks. The thought is that banks lend the money out. People pay the loans back. The bank has money. If I've got money in the bank, it's insured to a certain amount, so if something happens to the bank, I get my money back. What happens when a bank gets boatloads of money in a short period of time? Because there's not so much you can lend out at any time. What do they do with all that extra money?
Well, that's a great question, Rob. And so what you just described is exactly what happened. So they had this incredible influx of deposits. I said the bank grew, almost tripled in 3 years. The deposit base actually more than tripled in a little more than 2 years. And so what typically happens, what leads to, historically leads to bank failures would be liquidity issues around credit issues, around loans. What led to the failure for SVB was something completely different. And it's a bit of a mismatch between all those deposits that came in. As you said, they would generally lend those out, and any excess deposits they would have, they would keep as cash or invest in the securities portfolio. So what they did is that while they were investing in the securities portfolio, they have what is now described as short-term deposits, and they were taking long bets in the securities portfolio. And so they had a mismatch of duration.
So to put that in layman's terms, I bring my money to the bank, I just put it in my savings account. They were taking the money and then investing it in longer term, say 10-year treasuries or something.
Yeah, great question, Rob. I read a report that was just released this morning that perhaps as much as 56% of their deposits, they converted into instruments that were greater than 15 years in duration. Mm-hmm. So to your point, taking your savings deposit and redeploying that into a 15-year investment.
So now I come to the bank and I want to take my money out to buy a car, and they've got it tied up in a 15-year treasury, which, because interest rates have been going up, caused the value of those treasuries to do what?
Those values go down. And so everyday customer comes in to withdraw money from your savings account, that can be satisfied by a bank that has a healthy liquidity position. And prior to the second quarter of 22, SVB had a solid liquidity position. What happened subsequent to that is the very industry that they were concentrated in, you're starting to see cracks in that industry, and that's the technology industry.
Why do they have such a run on depositors all of a sudden? If the depositor had not decided to take the money out, they could have survived. But why did so many folks decide to take the money?
Bill, that's exactly right. So they have a high concentration in one particular industry. So you got venture capitalists who are involved in this high-tech, biotech industry. And so you started to see those deposit balances shrink regardless of what happened to SVB. That started happening at the end of the second quarter in 22. So SVB had experienced an outflow of deposits of over 13% before the end of 22. So their problems were beginning way before the events leading up to their demise a few weeks ago. So you were having the technology industry that really kind of experienced the big squeeze as the Fed was moving in a direction to tighten the money supply. That was having a direct impact on that particular industry. So cash was starting to dry up.
Okay, that's the case with CVB. What about Signature Bank?
Very similar case. You've got a high concentration in one industry. You were redeploying those strong deposits.
That one industry been what now? Signature.
So in the startup technology business and venture capitalist fund money. Yep.
Maria.
So what prompted them to take this huge amount and invest in this particular? I mean, they thought this was going to be a good return for them in the securities world. And, you never know. It's kind of a crapshoot, right?
Right. It's no different than any one of us managing our own portfolio, right?
Okay.
So in SVB's case, Silicon Valley Bank's case, they had what's considered a very low loan to deposit ratio. In simple terms, how many deposits you collect and how much you lend out.
Okay.
They had a very low loan to deposit ratio. They're also a for-profit company, right? And so they need to deploy those deposits into an instrument and to produce yield. And so they invested in a securities portfolio because their loan to deposit ratio was below 50%. So greater than 50% of their deposits.
It looked good.
It looked good. And the instruments themselves were solid. The challenge for SVB is they took, in our industry, we call it extension risk. They were mismatching their deposits with their investments.
So different tactic here. So story on the front page today by the Associated Press, Army of Lobbyists help water down banking regulations. Talk a little bit about that premise and, how this all happened and sort of the role of Washington in the whole scenario.
Well, there's going to be a whole lot of time and opportunities to dissect this process. A lot's been talked about some ratios that haven't received a lot of attention. And certainly duration risk in the securities portfolio gets a lot of attention. But as it relates to a bank that has a high portion of their investments, of their deposits, concentrate in the securities portfolio, and when you overlay that into your duration risk, I think that's a component that's going to deserving to get a lot of attention from regulators.
Excuse me a second, Mark. Duration risk. That's not a term we've used before. I've heard before. So what do you mean by duration risk?
Thank you for that, for asking that, Bill. And so if you look at investing in a traditional yield curve, if you look at investing in a CD, and you want a 6-month CD versus a 5-year CD, as an investor, you would expect to get a higher return for that 5-year CD. You also recognize that I've got a longer time before I can get access to that CD, right, in order to withdraw that. The same happens in the securities portfolio. So the longer you go out the curve, the greater yield you anticipate getting, but you're taking what's called duration risk until you have access to those funds, until they become liquid to you. Rob made an excellent point. When you go out that rate curve, you're also taking some interest rate risk. When interest rates move, and in this case moved up significantly, it decreased the value of that. So you can otherwise, what's called, you'll hear what's referred to in the market, hold to maturity. If they had time to ride out those 15 years, they would have been made whole. But because 56% of their deposits were invested into greater than 15-year instruments, that created a big mismatch in that duration.
Okay.
So talk a little bit about the community banks, which is what we are well familiar with here, the CNBs, the BCTs, and where they fit into this whole schematic. Because I'm imagining that you're getting lots of calls from your from your clientele, nervous. I mean, because most people don't understand sort of the whole piece.
Sure, Maria. Thank you for that, by the way. I appreciate that tee up. So there absolutely are pretty significant differences between a community bank and what you call large or super regional banks, and it's really the way we function. So the community banks, we're right here, right? Let's start with that. So we collect local deposits, and we make local loans. And we manage our concentration, we manage our risk. So we don't have those big concentration concerns, and we manage that every day. We have local bankers who really understand our local markets. So we understand the risk of our local markets. And we have a board of directors that are also all local and understand and have local market expertise. So there's that's the beginning of the fundamental differences. And so Janet Yellen recently reported that, I believe it was yesterday, and she referenced in particular community banks. Community banks provide critical credit and financial services to families and small businesses in rural America, and they make a difference in rural America. And so I think there's certainly recognition amongst, in this particular case, the Secretary of the Treasury, the critical role that community banks play. We just manage our balance sheet very differently than what a larger bank does.
After you loan quite a bit of money out, but you made the case with CVB that their loans was exceeded by their investments, by their investment bonds. Do you also invest, community banks? I assume you also invest in bonds as well. But is it just the size of your investments that makes the difference between you and the larger banks?
Yeah, indeed, Bill, we do. So oftentimes we have excess deposits over our loans. Yeah. And so for community banks, we keep a portion of that in cash, and then a portion of that we'll invest into the securities portfolio as well. And we manage that risk by managing the duration. So our general duration is very short. We give up yield to do that, meaning we don't get as big of a return, but because liquidity is so important to us and we want to be able to be nimble, we will give up those returns in order to maintain strong liquidity positions.
Let's go back to Signature for a couple of minutes. I'd heard earlier that the Signature's problem was not in the technology industry, it was the crypto industry. Is that was not the only difference between that and CVB, was it? Or SVB?
Well, from what I understand is they had some direct exposure to crypto, but also a lot of tech companies, startup tech companies that were involved in the crypto space. Okay. And a lot of the venture capital money that was funding those was beginning to dry up. And there's some real reasons why that money was beginning to dry up. But I think there are differences, at the same time similarities between those two.
Okay, so I'd not heard the similarities. I heard the differences initially. So we've had two or three of these tech invested banks that have failed. Are there others on the horizon that are very vulnerable?
Yeah, I'm not aware of those. there was a recent report produced that kind of honed in on the top 10 banks with the largest portion of uninsured deposits relative to their overall deposits. And I think there's some effort kind of digging into those banks. They're all super regional banks. They're not in the community bank space at all. So they're not banks that I typically follow.
Okay. Let me go back to a point that Maria raised a couple of minutes ago, and that's regulation. In our world today, every time something goes wrong, goes south, politics is very quickly woven in. And there were charges that these bank failures were a direct consequence of watering down or weakening the regulations back in 2018, I guess. How much validity do you put to those claims?
That's yet to be seen. I think there's going to be some. I think there are legitimate concerns that have been raised about that. What happens, and this was a direct result of the Dodd-Frank, a lot of these regulations, and the banking industry is no different than all other industries. It takes a crisis that drives that, that a lot of these regulations are born out of. And then what happens is there's a bit of an overreach. And I think they're good intentions, but there's a bit of an overreach. And then it takes a couple of years to claw some of that overreach back. And to your point, Bill, did we claw too much of that back, which triggered some of these concerns? Maybe. But I'll say this, again, historically speaking, bank failures as a result of liquidity has always been driven by the credit side. This was not driven by the credit side. This was driven by a high concentration in a specialized industry that when the money started to dry up in that industry, the bank in which survived for many years relying on that industry got themselves in trouble literally when I say overnight, in 5 hours, 43 billion or 20% of their deposits disappeared. Sure. That's unheard of. And again, so I don't know of any regulation that was pulled back in 18 would have addressed that specific issue.
That's a great point.
Yeah.
By the way, because and no one's made that point yet that I've heard. It's mostly been focused on, well, if Trump wouldn't have relaxed regulations in 2018, this would have never happened, as opposed to the scenario that you just painted here, which is the first time I've heard that pointed out, Bill.
Could I extend this one step farther and see if I'm right, Mark, that the regulations are prior? You say most of the failures in the past have been due to the credit side. Could you make the argument that the regulations are targeted more to the credit side than the investment side? Or is that too far a reach?
Boy, that's my good friend Bill that I serve on a board with always asks really good questions and penetrating questions. It's nice to see he doesn't just do that on the hospice board. And so it's a really good question. Certainly a lot of attention is given to the credit side because that's what triggers historically a lot of the failures. But it's not that they don't spend a lot of time on liquidity, capital, et cetera. One of the first articles that I read about SVB was no amount of capital was going to protect this bank. And so the regulators spent a lot of time on capital too. Yeah. So I think it's a really fair question. I happen to be a banker that I don't want to say embraces regulation, but I look at regulation a little bit differently than maybe some of my brethren. I serve on the Consumer Financial Services Committee of the ICBA, which is the large association for community banks, because protecting consumers is paramount to me, and I think that's critically important. So I'm not, by no means am I anti-regulation, candidly, I'm the other way, but we need to right-size the regulation and protect large depositors and borrowers.
You used a good term there, the right size, and I assume that the challenges and the philosophy of a small bank, community bank, differ from that from the large bank. Have the regulations in the past been one size fits all, or is there a portion of the regulation that's more applicable, more directed toward the community banks as opposed to larger banks?
It always starts out with one size fits all, and then we really work hard to, I'll use the term again, right size it, because again, our model isn't particularly complex. Again, I'll go back, Bill, to we collect local deposits and we make local loans, and we really have expertise in our local market. So we really understand the fundamentals of our local market. And one of the things that's not been widely reported on is SVB was also in the investment banking world. So the very customers they had that were driving up their deposits, the venture capitalists of the world, they were also alongside of them investing and providing capital for some of those same startup firms. That is a complex world. And Bill, you know me, so you'll appreciate this. And I mean this half-heartedly, but you'll get my point. I don't know if I'm too smart not to do that or too dumb not to do that. But the point is, it takes a level of sophistication and a model that community banks, we stick to what we know, and we're very comfortable. The other component, Bill, that hasn't been widely reported on is the majority of our ownership of our community bank is right here in the Eastern Panhandle. We don't get the extreme pressures from institutional positions or big investment bankers to produce just untold revenues. We grow healthy, we grow prudently, and we don't get outside of our model. So we kind of stay in our lane, so to speak. So that helps a lot.
So to wrap up, so we're not expecting to see you or Alice Frazier as AKA George Bailey standing in the bank, waiting for the doors to close and standing there with that $1 in your ready to slip, put in your pocket.
I can say with a high degree of confidence, you won't see community bankers out there. And again, it's while we're all called banks, the way we behave is very different.
Sure.
Mark Harrell is our guest here, the president and CEO of CNB Bank. We haven't reset his name there in about 20 minutes here since if you just kind of tuned in halfway along the way. We've been talking about the banking crisis here. Bill, hold your question a moment there. I want to ask about, before we run out of time, FDIC insurance, which when I was a much younger person, it was $250,000. I'm a much older person now. It's still $250,000 despite inflation. Does the federal government need to address that number and adjust it for the modern times?
Yeah, I believe they're going to adjust it. It was, I want to say, Rob, around 13 years ago, where it was moved from 100,000 temporarily to 250,000, and then it does take an act of Congress, so that was officially adopted to 250,000.
Really, an act of Congress?
Yeah, and so I did some research, and that would translate to 350,000 today. And so it would really take a lot of work for the FDIC to continue to rebuild their coffers to get to that number. There's some $17 trillion in the bank in the domestic banking space today, and it's estimated about $10 trillion of that is insured. So it's not unusual that banks have a large uninsured portion of their deposits, around 40-some%, depending on the bank. Ours in the community bank space is much lower than that. But it's not unusual for banks to have a percentage of their deposit base uninsured. What's really unusual is SVB, thanks for asking the question, it's 90%. And what's more important than 90% is the few number of customers that represented that 90%.
Wow.
So they were top heavy.
They were really top heavy. And so you can imagine if you just stop at 90%, that would be really concerning, right? If you look at 90% and then you peel that layer back a little bit and you say, wow, that was 90% spread over a very few number of customers. It's been reported that Roku, as an example, had $500 million in their checking account. And so when you have
to make payroll?
Constant, that was in their operating account, from what I understand. Yep. So
well, what do you do? Let's say you're a community bank and you've got somebody who started up a company and they became a billionaire overnight and they're looking for a place to put their money. And they're like, hey, I know you. Can I give you my money? It's an interesting scenario there.
Absolutely. You want to align yourself with a bank who has some options to give you some peace of mind. Again, it's not unusual for a bank to have a percentage of the deposit that's uninsured. But there are those like CNB Bank who have various options available to you to expand your coverage beyond 250,000.
Go ahead, Bill.
Yeah. 250,000 to me has always seemed kind of like an arbitrary figure. It's insured by the federal government. The federal government, if there is a case of emergency, always funds things off budget. We do that in emergency, and we do that with a lot of things. So it doesn't really count against your budget. which we can debate that all night. But is there any reason that the FDIC could remove all limits altogether, all ceilings, and just have all deposits fully insured?
That's certainly being discussed at this point. And so there have been some projections run. And again, I think these are at the high level projections, but it's anticipated that if they flip that switch and made all deposits insured, it would cost the banking industry about 3 to 4% of the earnings of their revenue. Over the next 10 years. So you're basically taking out about a third of the net income out of the banking community. That in itself may be acceptable, but it too is in the.
Okay, so the FDIC, the banks are self-insuring, and it's not been insured by the federal government.
That is a really great point. So all FDIC insured banks are issued an assessment for their balances, and so we all pay a fee every year to offer FDIC. Not unlike you pay a premium for your car insurance.
I'm not sure that point is generally known. I did not know it. I just assumed it said backed by the federal government, that it was being backed by the federal government and not by the money contributed by the banks themselves.
Correct. So if we have $1 billion on deposit, there's an assessment relative to that number that we pay as an expense. We expense it off of our profit and loss statement, and we pay to the FDIC. Early accounts of what this was going to cost the community banking space, as you recall, the Fed came out in a joint statement and said we're going to cover unlimited amount regardless of the insured amount. Well, that made us all feel good about the confidence in the banking system, right? For us bankers, we said, okay, what's that going to cost us? And early estimates are about double what we're paying now, which, okay, you can absorb that. It's hard for me to get my head around how that doesn't affect the taxpayer, because at some point that's going to affect the taxpayer.
Yeah.
Mark, we are just about out of time. Any final words for the comfort of our listeners who have money in banks, maybe yours, in fact, and want to make sure that when they look for their money tomorrow, it's still there?
Sure. And again, Rob, I just wanted to thank you and Maria and Bill for this opportunity this morning. I was born and raised in this community, and I feel really good about the banks in the Eastern Panhandle and Western Maryland. What I would say is I would not characterize this as a banking crisis. I've lived through a banking crisis. This is not at all rises to that level. I think all of us have to just be patient, allow the third parties to really dig into this and understand and confirm what we're beginning to understand now, that this is unique to maybe a handful of banks and not what's generally accepted practices for banks.
Mark, thanks so much for coming in. I appreciate it.
My pleasure.
Thanks,
Thank
Mark.
you.
Okay.
Good stuff. Mark Harrell, President, CEO of CNB Bank.